Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Smart Investment Strategies for Recession-Proofing Your Portfolio. Smart Investment Strategies for Recession Times. Investing during a recession doesn't have to feel like walking a financial tightrope. While the economy might be shaky, there are specific strategies that can help you protect your money and make the most of opportunities. The key is to focus on stability, preparation, and consistent decision-making. Let's break down some smart approaches to keep your portfolio steady and your stress levels low. Focus on defensive stocks and sectors. Not all sectors feel the pinch of a recession in the same way. While industries like luxury goods and travel often take a hit, defensive sectors, those that provide basic needs and services, tend to hold up well. Stocks in industries like healthcare, utilities, and consumer staples are often less vulnerable during downturns because their demand stays steady. Healthcare. People still need medications, treatments, and doctor visits regardless of what's happening in the economy. Companies in this sector often have stable earnings and lower volatility. Utilities. Electricity, water, and heating aren't optional expenses for most households. Utility companies tend to generate consistent revenues even in tough times. Consumer staples. Goods like food, beverages, and household items remain essentials. Major players in this sector, such as supermarkets and producers of everyday products, are considered reliable choices. Think of these industries as the essentials aisle of your portfolio. They may not offer rapid growth, but they provide stability when consumer spending shifts. Diversification as a risk management tool. Don't put all your eggs in one basket, might sound cliché, but it's sound advice. Diversification is the practice of spreading your investments across different asset classes, sectors, and geographies to reduce risk. If one area takes a hit, others in your portfolio can help balance it out. Here's what diversification can look like. Asset classes include a mix of stocks, bonds, and possibly commodities like gold. Stocks offer growth potential, while bonds provide stability. Sectors. Spread investments across industries. If tech struggles, healthcare or utilities might still deliver steady returns. Geographic areas. Don't just focus on domestic markets. International investments can protect your portfolio if one region faces a severe downturn. Diversification doesn't guarantee gains, but it helps cushion the blow when markets are volatile. Investing in dividend-paying stocks. When stock prices drop, dividend-paying companies can feel like a financial lifeboat. Dividends are payments made to shareholders, typically from a company's profits. They provide a steady income stream, which is especially valuable during a recession when other income sources might be less certain. The benefits of dividends include consistent income. Even if stock prices fall, many companies maintain their dividend payouts, offering reliable cash flow. Reinvesting for growth. Reinvesting dividends to buy more shares can compound your returns over time. Stability. Companies that pay dividends are often larger and more established. They tend to have healthier financials, making them less volatile during economic downturns. To start, look for dividend aristocrats, companies with a long history of both paying and increasing dividends. These firms show resilience and commitment to rewarding shareholders, even in tough times. Building an emergency fund first. Before pouring money into the market, it's critical to ensure you have a solid safety net. An emergency fund protects you from unexpected financial shocks, like job loss or medical expenses, which can feel more common during a recession. Here's how to build and maintain an emergency fund. Save 3-6 months of expenses. The exact amount depends on factors like job security and family size. Keep it accessible. Store your fund in a high-yield savings account or money market account. The goal is to have quick access when needed. Prioritize this over investing. While it's tempting to chase low stock prices, having cash reserves ensures you don't have to sell investments at the wrong time. Think of an emergency fund as the foundation of your financial house. Without it, even the savviest investment strategy can crumble under unexpected pressures. Avoid emotional decision-making. When markets are in free fall and headlines scream about economic doom, it's easy to panic. But acting out of fear often leads to poor decisions, like selling investments at a loss or avoiding opportunities altogether. Staying calm and rational is essential. Here's how to maintain a disciplined mindset. Stick to your plan. If you have a well-thought-out investment strategy, trust it. Recessions are part of the economic cycle, not the end of the world. Ignore daily market noise. Focus on long-term goals instead of obsessing over short-term fluctuations. Automate investments. Consider setting up a system of regular contributions, like dollar cost averaging. This approach spreads your investment purchases over time, helping you avoid emotional timing mistakes. Seek objective advice. If you're overwhelmed, a financial advisor can help provide perspective and keep you on track. Think of staying disciplined like driving through a storm. Turning off the headlights and pulling over doesn't help. You need to stay focused on the road ahead, knowing the skies will clear eventually. Alternative investment options. During a recession, traditional investments like stocks might feel too unpredictable. This is where alternative investment options can provide a path to stability and potential growth. By exploring these less conventional opportunities, you can diversify your portfolio and build a financial cushion to weather economic downturns. Here's a closer look at some powerful alternatives. Real estate opportunities. Recessions often lead to a cooling in the property market. While this sounds like bad news, it can actually benefit investors who are ready and able to act. During an economic slowdown, property prices may decline due to lower demand and tighter credit markets, creating opportunities for savvy buyers. For example, discounted property values. When sellers feel pressured to offload properties quickly, buyers with cash or pre-approved financing can negotiate better deals. Lower competition. Fewer buyers in the market mean less bidding wars, giving you more choices and room for negotiation. Long-term potential. Real estate often appreciates over time. If you can hold on to the property until the market recovers, you're likely to see significant value growth. If buying property outright isn't an option, consider strategies like house hacking, renting part of the property, or partnering with other investors to split costs. These approaches let you benefit from a down market without overextending financially. Bonds and fixed income instruments. Bonds are often viewed as a safe haven during recessions, and for good reason. Unlike stocks, which can swing wildly in value, bonds provide steady, predictable returns. When markets are shaky, this stability can be a much-needed anchor for your portfolio. Why are bonds so reliable? Guaranteed payments. Bonds pay regular interest, which can create a steady income stream regardless of market conditions. Government-backed safety. U.S. Treasury bonds, for example, are considered one of the safest investments since they're backed by the federal government. Portfolio balance. Adding bonds can help reduce overall risk in your investments, especially if your stock holdings take a hit. Corporate bonds can also be an option, but stick with highly rated bonds, e.g., AAA or AA ratings. These companies are more likely to meet their debt obligations, even during tough times. Precious metals as a hedge. Gold and silver have long been considered safe haven assets during financial uncertainty. Why? Because their value often moves independently of stocks and bonds. In fact, precious metals tend to rise in price when markets are in turmoil, making them an excellent hedge against recession risks. Here's how they help. Protect against inflation. If a recession is paired with rising prices, gold and silver can retain purchasing power better than cash. Diversification. Adding a small allocation of precious metals to your portfolio reduces reliance on traditional investments. Investors can buy physical metals, like coins or bars, or invest in ETFs or mining stocks for easier access. Just remember, metals don't generate income like dividends or interest, so they're more about preserving value than creating growth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.